Hello, and welcome to SCG Global Spin. Our host today is Henry Bubel. Henry has over 40 years of tax experience and has been at Patterson Belknap for more than 40 years, where he was a partner for decades and now operates in an of-counsel capacity. He has an in-depth knowledge of the income taxation of both corporations and partnerships, as well as estate, gift, and trust taxation. In addition to his work at Patterson Belknap, Henry serves as a director of both closely held businesses and charitable foundations and as trustee of client-related trusts. He was previously the board chair for SCG Legal. Joining Henry is Matt Carlson. Matt is a counsel at Boutin Jones and has over 10 years of tax controversy planning and transactional experience. He was previously an attorney for the Office of Chief Counsel, IRS, where he represented the IRS in federal tax and bankruptcy proceedings. He is a frequent speaker on tax issues, including opportunity zones, tax litigation, and other tax issues at seminars for the California Lawyers Association, Sacramento County Bar Association, California Society of Enrolled Agents, Cal CPA, and events for private companies and accounting firms.
All right. Well, thank you for those introductions. It's a pleasure to join you now, and with my co-host Matt Carlson from California. Many of us personally have been affected work-wise by COVID-19, and not just personally, but some of us are going to be suffering some tax consequences or some tax uncertainties that arise from COVID-19 working arrangements, and that's the subject of this particular webinar. Today, we're going to focus primarily on the state and local aspects or issues that concern the bulk of us. So we'll have a separate program that concern the cross-border issues when people from one country get stuck in another country. So with that said, I'm going to try to talk a little bit about the things going on the East Coast. Matt's going to try to talk about some of the things going on the West Coast, simply because the state laws vary significantly, even among the East Coast states, and therefore the issues that arise may vary. But let's start with New York, only because that's my town, and it's the ones I'm most familiar with. In New York, we for years have rules that look at where a person physically is doing their work, not to determine whether they're a New York resident, that goes by where they sleep at night, but for services income, we look at where a person's doing their work. So if I, a resident of Connecticut, may normally work for a New York City firm where I normally have an office, New York State takes the position that I'm rendering my services at my New York office and that the revenues produced are New York source revenues. And it wants Patterson Belknap to recognize that as when it figures out the geographic source of the partnership's income. And it wants me to pay personal income tax on my New York source compensation. All that, I think, worked very well until COVID, when we ended up, at least like a lot of New York firms, with a lot of people who live in New Jersey or in Connecticut, okay, and have been working at home for 6 months or more now, not being able to go to their normal place of business. Let's just stop there and say the issues come up for the employer and for the employee. Lots of people in the chain that this affects. So for Patterson, it has to decide, well, have I changed my place of work? Should it be withholding Connecticut income taxes because it now has an employee who's based in Connecticut? Or they could ask the same question about New York. Thus far, I can say New York employers have not been changing their withholding structures and have been withholding New York tax um, just as they always did, even if someone lived in New Jersey or Connecticut. Okay. And then they leave it to if it's an employee, they would leave it to the employee to do an allocation on their own personal income tax return for where they were physically day by day, and maybe prorate the New York income, maybe get a refund in Connecticut, maybe have to pay some tax in Connecticut. Rates aren't that much different, so it doesn't matter here. Matters a lot as we move northeast to Boston, where Boston has significant taxes on people working and earning money in Massachusetts, but a lot of them live across the state line in New Hampshire, which has no income tax. The Massachusetts has already given guidance, which puts it in the rare exception of states, and said we're going to continue to tax that person living in New Hampshire just as if they had continued to go to their office every day and earn their money in Boston. New Hampshire immediately fired back and said, no, you're not going to be able to do that. We have to protect our residents, okay, from other states trying to unfairly impose tax on them. So there's already a brouhaha going in those jurisdictions. Okay, we don't have guidance from the states yet in New Jersey or Connecticut, so can't say. Moving down the East Coast, Washington, D.C. has had a multi-state, if you want to call it that, compact with Virginia and Maryland for quite some time, where the D.C. employers withhold tax and pay it over to Maryland and Virginia based on where the person actually lives. So again, we have a different set of rules going on there. Once you get further south than that, you really don't worry, because the next big population centers are in Florida, and very relatively few people are working cross-border there. But I'd be curious for input if you're listening to this webinar in the future and you'd like to give me some update or some input on what's going on in your East Coast jurisdiction, please do so. I want to turn for a minute before I get to the West Coast to the employer side of it. The question is my law firm doing business in Connecticut, even though it has only one physical location in New York City, okay? Because it has a handful of people living and working at their homes in Connecticut. It has probably more than two handfuls of people or more living and working in New Jersey. Okay? Well, half of the answer is simple. New Jersey has long taken the position that if you've got people in your firm working in New Jersey, you have to file a New Jersey return and allocate your partnership's income among New Jersey and the other states. So we've been doing that, and of course we have our lawyers code their day notes so that we can come up with a rough idea of how much income is allocable to New Jersey. Connecticut does not yet have that rule, and I think that it's certainly the minority rule. Okay, I think I've said enough for now about the East Coast, and I would like to hear Matt talk about the West Coast.
Thanks, Henry. A little bit different out here, just by virtue of California's geography. A larger state where, along the borders, there are not many major metropolitan areas. So Northern California, we've got Lake Tahoe, we've got the Reno area. That's the major metro area up north. Further down south, we've got Las Vegas, Nevada. We've also got Phoenix, Arizona, and a few other cities around Phoenix. So those are really the major metro areas that are, within a few hours of the California border. So we don't have a lot of ordinary commuters coming in from California to Nevada and Arizona or vice versa. It happens, but it's not quite as common. In my area in particular, it does happen a lot in the Lake Tahoe area. And some of that, at least, is driven by the fact that Nevada does not have an income tax. And so people are very keen on being residents of Nevada and having income sourced to Nevada and that kind of thing. So, but it's a little bit different. We don't have a lot of people coming in from out of state to work in Sacramento or the Bay Area, for example. It does happen, but not quite as common as other parts of the country. That has changed to some extent now that we've got everybody working from home. With our firm, for example, a lot of the folks work from home. And at least some of them have, properties in the Lake Tahoe area. I've got friends with cabins in Lake Tahoe that are on the Nevada side. And so if they're working from home, how is that going to impact their income tax liability? How is that going to impact their employers' withholding requirements for them? And California, like a lot of other states, if you're a resident, you're going to be taxed on your worldwide income. And so if you're out of the state temporarily for a temporary or transitory purpose, that doesn't change your residency. You're still going to be expected to report all of your income in California. And so moving up to Lake Tahoe to get out of the heat for a few weeks or a few months, that isn't going to lift that requirement. And I think a lot of people are going to be seeing that for the first time, because I have seen at least articles about people moving up and working remotely from South Lake Tahoe, or from the Nevada side of Tahoe. And it's going to be something that is addressed through normal residency audits, I think, in the future. And so that is an area where the Franchise Tax Board administers the income tax in California. The Employment Development Department administers the payroll taxes. We have a few other taxing agencies too, because California couldn't just have one taxing agency. We've got to have 5. So, but for this issue, it's really the Employment Development Department and the Franchise Tax Board. And we see a lot of the residency audits here. They're very active in that area. And part of it is driven by the fact that people move to Nevada and don't pay California income tax. I've got a few that I'm handling right now that are picked up through information reporting to the IRS. So W-2s, 1099s, other reports that go to the IRS are then shared with California through an information sharing agreement. And if there's a California address for the recipients, they're going to get an inquiry in almost 100% of the cases. And if you don't respond to it, there's going to be an assessment, and then you've got to try to clean that up after the fact. So we are going to see a lot of these issues in the future, but for now, we haven't seen really much guidance from the state. And so I think we can just expect that the default, normal rules that have applied for years are going to continue to apply, even if, we've got a new fact pattern to consider here.
I think that's the basic question. Given the lack of guidance in most jurisdictions, are we going to get some guidance? When this started, nobody knew whether we were talking about a 2-month or 3-month or 4-month situation. Now we're already 6 months into it. The federal government gave some guidance for non-resident aliens who got stuck in the U.S. and couldn't return. Okay. But very few states have given any kind of similar guidance. Do you see any coming on the West Coast between now and, let's say, January, when reporting season begins? Or do you think people just fall back and say, let's look at it on audit. Let's see how the chips fall.
Yeah, I would hope to see some guidance from both the Employment Development Department and the Franchise Tax Board. The EDD has provided a lot of guidance for coronavirus-related issues, but really it's been mostly on the unemployment side. So recipients of unemployment benefits, it's been a very active area. So there's been a lot of guidance on that, but not a whole lot, for tax withholding issues. And then the Franchise Tax Board has been pretty silent on income sourcing and residency and things like that. So it could just be that we fall back on the normal residency rules, and it will be enforced through examinations.
I think the employers seem to be on pretty safe ground, simply continuing to withhold payroll taxes, income taxes on payroll in the state in which they're located, and not worry so much about where the employee is physically located during the COVID period. So it's putting the onus more on the employee for taking their own reporting position. And that's probably the reason why the states haven't really given urgent guidance, because it's a little too soon for that. But one of the more common ones at the federal level, which we should touch on for a minute, is the rules about home office deductions, which have changed over the years. The current rules say that if you're an employee, you can't take a home office deduction because your place of business is deemed to be where you have your desk at your employer. That, of course, has not been true for many people for the last 6 months. In New York, for example, we're still working remotely. Most people are still working remotely. Some people go into the office on rare occasion. I made my first trip into Manhattan last week in 6 months. Okay? And so it'll be interesting whether Treasury gives any kind of guidance or if you will, forgiveness for that situation. Partners in firms, of course, can have still been free to do that to a greater extent. The law is a little less clear on that. So that's a one that affects us all.
Right, and I agree that on the partner level, I think those are typically treated as unreimbursed partnership expenses, that type of thing.
Right.
Whereas
you have to try to claim it on your Schedule E as an adjustment to your partnership income. Right.
Right.
And
it's a pretty rare issue I don't see, but I can see it coming up here.
Yeah, I happen to know a partner of a very large New York firm who spent 3 months in Montana this summer, avoiding the quarantine, and I'm sure Montana could balance its budget just on his taxing his share alone, but I don't know whether they'll find that out or not.
There is a problem on the employee side. On the employee side, these are treated, I think, as unreimbursed employee business expenses.
Yes.
And if that lands on miscellaneous itemized deductions on the Schedule A, those have been suspended until I think 2025. And so that's another problem, is how do you deal with employees who now have increased expenses because they're working at home? What are they supposed to do? I think that the employer can reimburse them to some extent for increased expenses, internet usage. If their computer breaks or something like that, the employer can pay for it, and it wouldn't be an income item, I don't think. But that's stuff that people have to look at and think about is, okay, if this is going to be a long-term issue, how are you going to deal with your employees having a home office and incurring expenses, and how is that going to be treated?
Their printers will break. They will need more. They will need more ink. Other kinds of hardware will be needed. So the idea of having the internet is now an essential home access to the internet is essential, even if it wasn't before. Now, for business purposes, will the firms reimburse? All those kinds of questions will come up. I wanted to ask a tricky California question while I have you, which is, you mentioned the 5 different departments. Which one is going to administer your new wealth tax?
I don't know. So there's a 0.4% wealth tax that's on the table currently, and it's for residents with a net worth, I think, of over $30 million. I expect that would be administered by the Franchise Tax Board, but I guess we don't know. Because they typically handle employment, or not employment, but income taxes, and corporate income taxes and franchise taxes. So I expect that would be the agency to administer it. And then from there, if you have a dispute with the Franchise Tax Board, we have a new Office of Tax Appeals, which operates similar to the U.S. Tax Court, and they will handle disputes with a number of the different agencies.
So for those of you who haven't heard about this proposed new wealth tax in California, it's not just for California residents. Well, it is, but it defines resident in a weird way as anyone who spends 60 days or more than 60 days, I should say, in the state, even if you have a closer connection and a domicile in New York. So for those people who like to spend 10 weeks a year, in San Diego, the wealthy among them would find themselves subject to this proposed tax. So I've had a couple of client inquiries, none from my partners, about this new tax, the proposed tax. What's the timetable for when that's expected to be considered?
I think it's on the ballot for November. I could be wrong. It could be in the legislature, but it's been bouncing around over the past few weeks.
Okay, interesting. So it's certainly not likely to be effective for 2020. So you're not going to trap those New Yorkers into your wealth tax.
That's right. No, not yet. We'll get them next time.
Okay. Did I miss anything that we plan to cover, or is this a?
No, I think we've covered a lot. The one issue I did want to touch on was, what's an employer to do with employees that are located in California, and how to treat their withholdings. We do have a new law, AB 5. I don't know if you've heard of it, but it's a really expansive definition of who is considered an employee. And so this is a worker classification issue that you could see coming up, where you've got independent contractors. As a business, you've been treating them as independent contractors for years, maybe. And then all of a sudden, AB 5 is effective beginning in 2020. And now there's a AB 5 implements a California Supreme Court case called Dynamex. And Dynamex has an ABC test for who is an employee, which is a very common test in other jurisdictions. But it's very expansive, and it really creates sort of a rebuttable presumption that somebody doing work for you is an employee, and it's up to you as the employer to rebut that presumption. And so you could have somebody in California doing remote work. You've treated them as an independent contractor. Now they're going to be properly classified as an employee. And so that, of course, is going to trigger payroll tax, obligations, income tax withholding obligations. And if you don't do much business in California, it may be something that's very unexpected.
Yeah, it's my understanding, and please correct me if I'm wrong, that those rules and that test operate completely independently from, I'll call it, the 22 questions asked at the federal level for categorization of employee versus independent contractor. So you could find yourself federally in a situation where you truly have an independent contractor, yet in California, this same person doing the same thing might be considered an employee. And then you'll get to the question of, how do you determine whether that person has to be eligible for your health plans and your benefit plans, your retirement plans, which typically work off federal definitions, but not always. So
that's right. Yeah, and you could have an employee that meets the federal test but doesn't meet the state test in California now. There is a slight overlay to the common law rules, which is these 22 factors you're talking about. Once you get through the ABC test, I believe the way it operates is you still have to look at common law, and if they would be treated as an employee for common law, they still may be pulled back as an employee, even if you've met the ABC test. So it's a very, very tough test. There is legislation, or there's an initiative that will be on the ballot in November, Proposition 22. This would create an exemption for app-based delivery services and transportation. So Uber, Lyft, DoorDash, those kinds of businesses would be exempted from AB 5, and they could be classified as independent contractors. So that's a big thing that's on the ballot coming up in November.
Okay. All right. Lots to look forward to, right?
That's right.
Okay. So again, I am going to host a second one of these little talks in a few weeks with my colleague Jenny Longman, where we'll be talking about the people who are trapped in not just in a different state, but trapped in a different country. And I'm sure there'll be an announcement in plenty of time of when that'll be available to y'all. Okay, Matt, thank you so much for joining me this morning and co-hosting. And I'm sure we'll be speaking again soon. And thanks to those of you who have spent 20 minutes or so listening in. All right, and I look forward
Henry.
at some point to seeing you all at a meeting when we have meetings again. All right, bye-bye.
Bye.
And that concludes our recording. Thank you for joining us today. You can find this and many other episodes at scgglobalspin.com.